Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever seriously wondered how someone could turn $1 million into $1 billion? Well, today, we're going to pull back the curtain on one of the most incredible runs in the history of finance. We're digging into Glen Arnold's The Greatest Deals of Warren Buffett to break down the exact strategies that took him from being a millionaire in his 40s to a bona fide billionaire by the time he was 59. I mean, it's a question that sounds like it's straight out of a movie, right? But for Warren Buffett, this was very, very real. And it wasn't some lucky break. It was a deliberate, methodical process. So let's unpack exactly how he did it by looking at the core principles behind the deals that made him a legend. And the results, I mean, they just speak for themselves. Between 1976 and 1985, the S&P 500 doubled, which, hey, that's a pretty good run. But Berkshire Hathaway, its shares shot up by 29 times. You heard that right, 29-fold. This wasn't just outperforming the market, this was like playing an entirely different sport. So you gotta ask, how did he pull that off? Well, that kind of success is never an accident. It's the result of sticking to a few core principles with just incredible discipline. And the first one, maybe the most important, was his knack for spotting what he called inevitable businesses. He had this really cool name for these companies, economic franchises. Basically, these are businesses that have a competitive advantage so strong, so durable, that their success over the long haul is pretty much a sure thing. The best way to think about it is like a castle with a huge, deep moat around it that keeps all the competitors out. Coca-Cola is the perfect economic franchise. Just think about it for a second. Its brand is recognized in literally every corner of the planet. The product itself is simple and basically never changes. And it has this incredibly powerful connection to feelings of happiness and good times. That's the recipe for an inevitable business, and it's exactly why Buffett plowed over $1 billion into the company, starting back in 1988. And this quote, man, it just reveals a totally different way of thinking. For Buffett, the goal was never about making a quick buck. It was about becoming a permanent partner with these amazing businesses and just letting their economic moats do the hard work of compounding wealth for decades. But here's the thing, a great business is only half of the story. Buffett's second principle shows us that for him, the numbers on his spreadsheet were way less important than something else, the character of the people running the show. Okay, so this story about his 1983 deal to buy Nebraska Furniture Mart, it's become legendary for a reason. He bought a majority stake from its incredible founder, Rose Blumkin, or Mrs. B, with basically a one-page contract and a handshake. That's it. He didn't send in a team of accountants to comb through the books. He didn't check the inventory. He didn't verify the property titles. He never even asked for an audit. So why? Because he knew Mrs. B and her family. He knew their reputation in Omaha for being ruthlessly honest and unbelievably hardworking. And for him, that was way more valuable than any financial statement. And you might think, okay, maybe that was just a one-time thing. Nope. He did the exact same thing again in 1989 when he bought Borsheim's, a gigantic jewelry store run by the Friedman family. The whole deal took 10 minutes. It was based on 5 simple questions. And again, no audited financials needed. This quote right here, it just sums up his whole approach, doesn't it? For Buffett, you could learn a lot more about the health of a business by judging the character of its managers than by reading a 100-page financial report. His due diligence was really a test of integrity, not just inventory. So this deep, deep trust in people, it wasn't just about buying companies. It was about building partnerships. And that leads us right into his third principle. Using Berkshire's cash not as a weapon to take over companies, but as a tool to empower great leaders. You have to remember what the 1980s were like. It was the age of the hostile takeover, you know? All these corporate raiders using junk bonds to buy companies, break them up, and make a quick profit. And then you had Warren Buffett, who was playing a totally different game. He was the white squire, a friendly, stable, long-term partner who just gave great managers the capital they needed and then got out of their way. His 1986 deal with Capital Cities is a perfect case study. He puts in over $500 million, which let a CEO he trusted completely, Tom Murphy, go out and acquire the media giant ABC. With Buffett as a rock-solid shareholder, Murphy didn't have to worry about Wall Street's short-term demands. He could just focus on building long-term value. The result? The investment grew by more than 600%. But what happens when that trust is broken? This is where the story takes a turn. Buffett learned this lesson the absolute hardest way. His investment in Salomon Brothers became a true cautionary tale, showing that even if you bet on a few good people, a corrupt company culture can ruin everything. His massive $700 million investment was suddenly on the line. A trader had been systematically breaking the law, but the real bombshell was finding out that top management knew about it for months and it covered it up. With Salomon Brothers literally on the brink of collapse, Buffett had no choice but to step in himself, not just to save the firm, but to protect the reputation of Berkshire Hathaway. So when Buffett took over, his message to every single employee was crystal clear. The Salomon crisis was a painful lesson, for sure, but an invaluable one. A toxic culture will always win out, and in the end, reputation is the single most important asset you have, period. So when you step back and you put these three principles together, investing in inevitable businesses run by people you trust completely, and then acting as a patient partner, you end up creating something incredibly powerful. He basically built a financial flywheel. Think of it like this. Cash from Berkshire's insurance companies and other businesses gave the flywheel its first big push. Then Buffett and Munger would take that cash and buy more great companies, which would spin the flywheel even faster, throwing off even more cash. It just kept repeating year after year, building this incredible momentum. And that brings us right back to where we started, that mind-blowing 29 times return. It wasn't luck, it wasn't magic, it was the natural result of this powerful flywheel, just spinning faster and faster and faster. So it all leaves us with this one big question for today, doesn't it? In our world of high-speed trading, AI, and constant disruption, is there still a place for Buffett's patient, trust-first approach? Or maybe is that kind of patience, in the end, the one true competitive advantage that can never be automated?
You know, when you hear the name Warren Buffett, you probably just think of unimaginable wealth. But that empire, it wasn't built overnight, not even close. So today, we're going to pull back the curtain on what I think is the most crucial and honestly the most overlooked part of his entire story, the climb to his very first $100 million. It's a heck of a story, one that's full of grit, a little bit of genius, and this one powerful idea that really, it changed everything for him.
I mean, that's the big question, right? How in the world do you build a multi-billion-dollar empire from scratch? For Warren Buffett, the answer doesn't start in some fancy Wall Street boardroom. Nope. It starts with a little bit of cash, earned the old-fashioned way, through pure, unadulterated grit.
And this is where it all began. $114.75. Just think about that. Back in 1941, an 11-year-old Warren Buffett scrapes this exact amount together to buy his very first stocks. Now, the investment itself, it didn't really go anywhere spectacular. But that's not the point. What it did do was ignite something way more valuable. A lifelong obsession with figuring out how this whole market thing really works.
So long before he was the Oracle of Omaha, he was just a kid with an absolutely insane work ethic. I mean, we're talking about a kid doing 5 daily newspaper rounds, delivering the Washington Post. And that's not all. He was buying up pinball machines and renting them out. He was even going out and retrieving lost golf balls to sell. Seriously, anything to make a buck.
And you know what? All that hustling, it paid off big time. By the time he was just 20 years old, he had managed to save nearly $15,000. And get this is before his serious investing career even kicked off. This wasn't some handout, no seed money from his family. This was pure sweat equity, the result of a relentless, decade-long drive to just earn and save. This right here, this was the foundation on which he'd build everything else.
So you've got this foundation of capital, right? But what he needed next was a blueprint, a guiding philosophy. And he found it when, as a 20-year-old, he stumbled upon a book that would literally change the entire course of his life, The Intelligent Investor by Benjamin Graham. And listen, this wasn't just some book he read. It became his Bible, his operating system for investing, for the next 70-plus years.
So what was in this magic book? Well, Graham's whole philosophy really boils down to 4 kind of simple principles. First, do your homework. I mean, really do your homework. Know the company you're buying inside and out. Second, always, always, always buy with a margin of safety. It's a fancy way of saying, pay a lot less for something than what you know it's truly worth. Third, don't try to get rich quick. Don't swing for the fences. Just aim for satisfactory, solid returns over time. And finally, the one you've probably heard of. Treat the market like a moody business partner. He called him Mr. Market. And when Mr. Market is freaking out or getting way too greedy, you use those moods to your advantage.
Okay, so now he's armed with these principles from Graham, and it's time to put them to the test. His first big one? A company called GEICO. Turns out, while he was a student at Columbia, he finds out his professor,
Benjamin Graham himself is on the board of this kind of obscure insurance company. So what does Buffett do? He hops on a train to Washington, D.C., shows up at their headquarters on a Saturday, mind you, and basically just knocks on the door. He ends up talking to an executive for 4 straight hours, just grilling him about the business. He walked out of there so convinced that he put two-thirds of his entire net worth into GEICO stock.
And the result of that huge bet? A pretty quick and very impressive 50% profit all within a year. Now, by any normal person's standards, this is a massive win, a total home run. He followed the playbook, he did the research, and boom, he got rewarded for it. But, and this is a huge but, this is where the story takes a really critical turn.
Because that quick profit, he later realized it was actually a massive mistake. If he had done nothing, literally nothing, just held on to those shares for the next couple of decades, his small investment would have ballooned to $1.3 million. Talk about a painful lesson. What he learned was that a good, quick profit can sometimes be the biggest enemy of a truly life-altering return. The real takeaway? You just don't sell a wonderful business.
So that painful lesson, combined with his next major discovery, well, this is what would create the real engine for his entire empire. He became absolutely obsessed with the insurance business, but not because of the policies they sold. No, he was obsessed with its magical, secret byproduct, something called float.
All right, so let's break down what float actually is, because it's a game changer. Think about it. When you pay your car insurance premium, the insurance company gets to hold on to your cash, right? They don't have to pay anything out until you, maybe, get in an accident and make a claim. That could be years from now, or it could be never. That big pool of money that they're just sitting on, holding for you, that is the float.
So you can think of it like this. The float is basically a massive interest-free loan from all the policyholders. If the insurance company is good enough to just break even on its day-to-day business, they get this huge pile of money to go invest for their own profit for free. And if they're really good at their job and actually make a profit on the insurance policies themselves, well, then they are literally getting paid to hold and invest other people's money. It's the ultimate financial cheat code. So in 1967, Buffett decides to put this whole theory into practice. His company, Berkshire Hathaway, which at the time was just a struggling textile mill, buys an insurance company called National Indemnity. And the numbers, they're just mind-blowing. He pays $8.6 million for the company, and in return, he immediately gets control of its $17.3 million float. He got more cash than he paid. Then, by running the business well, he quickly grew that float to over $70 million. Suddenly, he had this massive, self-replenishing war chest, a giant pile of free money to go out and invest.
Okay, so fast forward to the mid-1970s. Buffett's endless hunt for value, combined with his mastery of this insurance float, had created a real empire. But here's the thing. It was not the clean, simple Berkshire Hathaway that we all know today. Back then, it was this powerful but incredibly complicated, tangled web of interconnected companies.
If you were to look at a diagram of it, you'd see 3 main companies at the center of it all. Berkshire Hathaway, another called Diversified Retailing, and a third called Blue Chip Stamps. The crazy part is, they all owned big chunks of each other. It created this structure that was frankly brilliant for pooling all his capital together, but for anyone on the outside looking in, it was just a confusing mess.
But inside that tangled mess were 3 separate pools of investment firepower. It was like having 3 different engines. First, you had Berkshire Hathaway with its huge insurance float, now over $70 million. Then there was Diversified Retailing, which had its own smaller insurance float, plus cash it was generating from its clothing stores. And then you had Blue Chip Stamps. Now this was unique. It had its own kind of float, a giant pile of cash, somewhere between $60 and $100 million, that came from the delay between when stores bought the stamps and when people finally got around to redeeming them for, a new toaster. So when you add it all up, he was controlling this massive river of cash flowing in from all these different sources.
And if you want a perfect example of this machine in action, here it is. He took that float money from all those unredeemed trading stamps at Blue Chip and used it to go out and buy See's Candies for $25 million in 1972. Think about that. One of the most legendary businesses in America, bought with other people's money. It was just financial genius at work.
Okay, now let's bring this whole thing full circle, right back to GEICO. So while Buffett is off building this crazy complicated empire, disaster strikes his old favorite company. The market completely panics, everyone is convinced GEICO is about to go bankrupt, and the stock absolutely collapses. It goes from over $60 a share all the way down to just $2. But for Buffett, this wasn't a crisis. This was his old mentor, Ben Graham's Mr. Market, having a total meltdown. It was the opportunity of a lifetime.
And now, armed with all that cash flowing in from across his entire empire, Buffett pounced. Between 1976 and 1980, Berkshire started buying up GEICO stock like crazy, eventually owning half the company for just $45.7 million. And the payoff? Well, it was just staggering. Fast forward to 1996, when they bought the other half of the company, the price tag was $2.3 billion. That's a 50 times increase in value. It was the ultimate proof of his philosophy. Find a wonderful company when it's in temporary trouble and back up the truck.
So, by the late 1970s, the strategy was totally proven. The float engine was firing on all cylinders. But that tangled web of companies that had given him his start, it was now becoming a liability. It was time to clean house. It was time to simplify.
So what was the problem? Well, the main issue is that this super convoluted structure, with companies owning pieces of each other, it had finally caught the eye of regulators. The SEC started getting concerned about potential conflicts of interest. What about the minority shareholders in all these different companies? Was it fair to them? And for Buffett, even the perception of unfairness was something he wanted to get rid of completely.
And so the great simplification began. Over the next 5 years or so, he and his now famous partner, Charlie Munger, folded everything into one single powerful company. Diversified retailing and blue-chip stamps were absorbed. The whole messy structure was streamlined under one simple banner, Berkshire Hathaway, the company that we all know today.
This cleanup act was really the final step in building the foundation of the empire. It was like all the complex scaffolding was finally removed, revealing this absolute financial fortress. What was left was a company with a clear command structure, a brilliant proven philosophy, and that seemingly endless river of cash ready to be deployed. The stage was officially set. The journey from 100 million to billions was about to begin.
So what if I told you that the greatest investor of our time made his best deal, not on some booming hotshot company, but on one that was literally just weeks away from being shut down for good? Well, that's exactly what happened. This is the story of Warren Buffett's single best bet. It's a wild tale of genius, total collapse, and one of the most incredible turnarounds in business history. Just let that sink in for a second. We're talking about a guy who's made countless legendary investments. For him to point to one and say that was probably the best, that's a huge statement. This wasn't just another smart move on the chessboard. This was his masterpiece. And what makes it so fascinating is that it all started not with a bang, but with a company that was totally about to go bust. Yeah, this was no investment in a thriving, healthy business. Nope. This was a high-stakes gamble on a company in a complete death spiral. I'm talking regulators breathing down their necks, ready to shut the whole thing down for good. So the big question is, how on earth did Buffett see value where everyone else just saw a pile of smoking ruins? To really get it, to grasp the genius of this whole thing, we've got to go back to the beginning. We need to understand just how perfect their original idea was. So, long before this whole near-death experience, GEICO was, more than just another company. It was like a beautifully designed machine. A masterpiece, really, built on a super simple but powerful idea that created what seemed like an unstoppable profit engine. Okay, so check this out. It's what you call a virtuous circle, a perfect loop. Here's how it worked. GEICO completely cut out the middleman. No expensive insurance agents. They sold directly to you, the customer. That simple move meant way lower costs, which meant they could offer much lower premiums. And of course, those low prices brought in a flood of applicants, right? So GEICO could afford to be super picky, ensuring only the absolute safest drivers. And safer drivers? Well, they have fewer claims, which, you guessed it, keeps the costs low. It was this brilliant self-fueling engine. And they were so disciplined about it. Selling directly just wiped out huge commission costs. They targeted only the most responsible drivers out there. At first, just government and military folks. And here's the crucial part. They passed those savings right back to their customers. This wasn't just about being the cheapest. It built this fierce, almost fanatical loyalty and amazing retention rates. It kept that virtuous circle spinning for decades. GEICO wasn't just a company, it was a fortress. But then a new set of managers came in and decided it was a great idea to tear down the walls. So, we get to the early 1970s and a new leadership team takes the wheel. Their whole mantra? Growth. Growth at any cost. And with that single-minded, reckless focus, they took this perfectly engineered machine and drove it straight off a cliff. And it happens so fast, it's dizzying. They just throw out the old playbook. That careful, selective strategy? Gone. They opened the doors to literally everyone. They just chased volume, insuring riskier and riskier drivers, splurging on new offices, you name it. And then it's like the world turned against them. Bam! New no-fault laws forced higher payouts. Bam! Regulators capped how much they could charge. And to top it all off, soaring inflation sent car repair costs through the roof. The result of this perfect storm? A staggering loss of over $126 million in one single year. You know, just a few years earlier, as management was chasing all that growth, Wall Street absolutely loved it. The stock soared to a dizzying $61 a share. The company probably felt invincible. But when the true scale of the disaster was finally revealed, the stock didn't just fall, it evaporated. It plummeted all the way down to $2 a share. That is a 97% wipeout. The market wasn't just pessimistic at that point, it was basically pricing GEICO for extinction. It was saying, this company is done. The shockwaves from this were felt everywhere. I mean, even Benjamin Graham, the literal father of value investing, Buffett's own mentor, was just floored. His take on it? You have to be a genius to lose that much money. Think about that. This wasn't just a simple mistake. It was a masterclass in self-destruction. Okay, so the company's on life support. Regulators are literally ready to pull the plug. It was going to take a miracle to save it. Or, as it turns out, two legendary figures. First on the scene was a guy named Jack Byrne. Think of him as the ultimate crisis manager, tough as nails, no nonsense. Brought in as the new CEO in May of '76. His job? Basically to perform a resurrection with only weeks to pull it off. Buffett himself would later call him the Babe Ruth of insurance. But honestly, even Babe Ruth would have looked at the problem Byrne was facing and probably walked away. See, he was trapped in this classic catch-22. It's like this. To survive, GEICO desperately needed to hand off some of its riskiest policies to other insurance companies. That's called reinsurance. But the reinsurance said, no way, not unless you raise a bunch of fresh money first. Okay, so he goes to the investment banks for the money. And they say, no way, not unless you get rid of some of that risk first. It was a total checkmate. No one would move first, and the clock was ticking loud. And this is where Warren Buffett finally steps into the picture. Because while everyone else was running around panicking about the fire, Buffett was calmly inspecting the foundation. He looked right past the terrible management and the catastrophic losses and saw that the core of the business, what he called its economic franchise, was still totally intact. That massive cost advantage from selling direct, still there. The incredible loyalty of its best customers, that hadn't vanished. That brilliant low-cost model was buried under a mountain of rubble, sure, but it wasn't fundamentally broken. So while the rest of the world saw a dying company, Buffett saw a world-class business that had just been temporarily crippled by a series of really, really bad decisions. And it was that conviction, that belief, that would become the key to unlocking the entire puzzle. You see, Buffett's investment created a new kind of virtuous circle. This time, it was a circle of confidence. It wasn't just about the cash he put in. It was about his public endorsement. Having Warren Buffett's stamp of approval was this incredibly powerful signal to the market that, hey, maybe this thing is salvageable. And that signal, it completely shattered the catch-22. His vote of confidence was the first domino fall, and it allowed everything else to happen. And here's how that high-wire act actually played out. Step 1, Berkshire invests an initial $4.1 million. Okay, not a huge amount, but the signal was everything. Step 2, armed with that endorsement, Jack Byrne goes back to the other insurers and, after a ton of arm twisting, convinces 27 of them to take on a piece of the risk. Step 3, with the risk now reduced, he finds an investment bank, Salomon, that's finally willing to back a massive, life-saving share issue. And finally, success. The deal closes, and just like that, GEICO was pulled back from the brink. But here's the thing. Saving the company was just the beginning. What happened next is what turned a brilliant rescue into one of the greatest wealth creation stories of all time. Just get a load of these numbers. By the end of that same year, 1976, Berkshire's stake was already worth $24 million. 5 years later, $200 million. By 1989, it crossed the billion-dollar mark. And by 1995, right before Berkshire bought the rest of the company, that tiny initial investment had exploded to nearly $2.4 billion. I mean, how is that even possible? Well, the secret lies in, you guessed it, yet another virtuous circle. Okay, so this is where we get to the real magic of insurance, something called float. Think about it like this. Insurance companies collect all our premium payments up front, right? but they only pay out claims little by little over time. So that massive pool of cash they're just sitting on in the meantime, that's the float. For most insurance companies, it's just money waiting to be paid out. But in the hands of a genius investor like Buffett, it's basically a giant, interest-free loan from millions of people. A loan you can invest to generate incredible returns. And GEICO, with its millions of loyal customers, was an absolute float-generating machine. Now, to manage all that float, GEICO hired an investor who was, in a lot of ways, Buffett's equal, the legendary Lou Simpson. This guy was the quiet genius whose only job was to take GEICO's float and turn it into a fire hose of investment profits. And his performance? It was nothing short of legendary. For almost 25 years, from 1980 to 2004, Simpson's portfolio averaged a return of over 20% a year. He absolutely crushed the market's 13.5%. Let me put that in perspective for you. Say you invested 10 grand in the S&P 500 over that time, you'd end up with about $237,000. Not bad, right? But if you'd given that same 10 grand to Lou Simpson, you would have ended up with over $1 million. He wasn't just managing the float, he was the turbocharger on GEICO's profit engine. And that brings the whole story full circle, right into the modern era. Under CEO Tony Nicely, GEICO basically went back to its roots, but with a modern twist. They poured tons of money into that iconic advertising we all know, the gecko. That drove a massive wave of new customers. And what do more customers mean? More premium volume. And more premium volume means more float, which means more money for Berkshire to invest, creating this incredible wealth-generating flywheel that just keeps spinning faster and faster even today. So when you boil it all down, what's the ultimate lesson from Buffett's best bet? It's really not just about buying a cheap stock. It was about having the vision to look past a temporary, even terrifying crisis and see the indestructible business hiding underneath all the mess. It was about having the raw courage to bet big when literally everyone else was screaming sell. And it leaves all of us with a really powerful question to think about. When the next crisis hits, and it will you be able to spot the incredible value that no one else dares to see?
All right, today we are diving into a business story that honestly plays out more like a thriller. It's a story of how Warren Buffett and Charlie Munger bought a newspaper that was in deep trouble and then had to endure 5 straight years of losses, legal battles, and union standoffs, all to win an epic newspaper war. It's really a masterclass in strategy, patience, and guts. So let's get right into it.
Okay, so to really get the story, you have to understand one core idea. For Buffett, the absolute perfect business is what he calls an unregulated toll bridge. A business that once you own it, you just sit there and collect cash as people pass through with almost no effort. It's a monopoly with incredible pricing power, and that is the exact prize they were chasing in Buffalo.
So here's how this whole battle unfolds. First, we're going to look at the broken down asset they bought in the first place. Then, we'll see the incredibly aggressive gamble they made that kicked off the war. We're going to walk through years of just financial pain, see the dramatic turning point, and then, finally, we'll get to the spectacular payoff and the timeless lessons you can learn from it all.
So let's set the scene here. We're back in the 1970s. This is way before the internet, of course. And in that world, being the only newspaper in town was like owning a license to print money. It was an absolute goldmine. The only problem? Everybody knew it. So whenever one of these monopolies came up for sale, the price was just astronomical.
And this slide really just says it all. On one side, you've got that ideal cash-gushing toll bridge that Buffett was always looking for. And on the other side, well, that's what he actually bought. The Buffalo Evening News, which was more like a broken-down bridge with a whole mountain of problems. This was not the easy, perfect investment everyone wanted. It was pretty much the exact opposite.
Let's just break down how broken this thing really was. First, Buffalo was not a one-paper town. It had a really fierce competitor, the Courier-Express. Second, its unions were so powerful it was kind of hard to tell who was running the company. Third, it didn't even have a Sunday edition, which back then was the most profitable day for any newspaper. And to top it all off, Buffalo itself was a Rust Belt city with a shrinking population. I mean, big players like the Washington Post had already taken a look at this deal and run the other way.
And yet in 1977, this is what Buffett and Munger paid, $35.5 million. At the time, this was the largest single investment they had ever made. It was a huge, huge bet on an asset that pretty much everyone else had decided was just too risky. But they saw something others didn't. They saw a path through all of these problems, a path to eventually owning the only newspaper in town, a path to building their very own toll bridge.
So what do you do after you make this massive bet on a really troubled company? Well, if you're Buffett and Munger, you don't sit back and play defense. Nope. You immediately go on the attack, and you aim right for your competitor's most profitable turf.
I mean, the plan was just breathtakingly bold. Munger had studied the industry, and he knew that without a Sunday paper, their long-term survival was pretty much in doubt. So before the ink on the purchase agreement was even dry, they decided to launch their own Sunday paper, a direct, head-on challenge to the Courier Express on its strongest day. They weren't just competing anymore, they were declaring all-out war.
And you better believe the Courier Express didn't just sit there. They fought back, hard. They launched a PR campaign painting Buffett as some out-of-town carpetbagger coming to ruin their city. They hit him with an antitrust lawsuit claiming the news was trying to illegally drive them out of business. They even got a judge to issue an injunction that seriously limited how the news could promote its new Sunday paper. The battle was on, and it got ugly really fast. And this is where the story gets really tough. That bold, aggressive opening move, it didn't lead to some quick victory. Not at all. Instead, it plunged the company and its new owners into a brutal 5-year period of just relentless financial pain and some very serious doubt. Just listen to Charlie Munger's own words from 1982, when they were right in the thick of this fight. He's actually calculating the opportunity cost, realizing they had basically vaporized tens of millions of dollars in value by buying this paper. This wasn't just a bad quarter. This was a multi-year slog that had even a titan like Munger questioning the entire decision.
This slide is basically the scorecard of the war, and it is just brutal to look at. After a teeny tiny profit in that first year, the numbers are just a sea of red ink. Loss after loss for 5 straight years, the paper was just bleeding cash. This is the kind of sustained pressure that just breaks most investors.
And remember, these losses weren't happening in a vacuum. The city of Buffalo was getting hammered by a deep recession, which crushed their advertising revenue. And at the exact same time, Buffett and Munger had to deal with 13 different unions, even threatening at one point to just shut the whole paper down if the strikes didn't stop. They were literally fighting a war on every single front. But then, after years of bleeding money and fighting all these battles, the tide dramatically and very suddenly turned. This is really the climax of the story, where a simple law of the business jungle took over. Survival of the fattest. By early 1982, things looked so grim that even Warren Buffett himself was apparently ready to throw in the towel, just accept a massive loss, and walk away. They were at their absolute darkest moment. But what their competitor didn't fully understand was that Buffett and Munger had a secret weapon, an ace up their sleeve, that made them almost impossible to beat in this kind of war.
And this chart illustrates that secret weapon perfectly. While the Buffalo News was losing millions, its parent company, Berkshire Hathaway, was becoming an absolute financial juggernaut. Just look at that dashed line soaring upwards. Berkshire's value was exploding. And what that meant was that they had incredibly deep pockets. They could afford to keep losing money in Buffalo, forever, if they had to. Their competitor just couldn't.
And then, just like that, it was over. On September 19, 1982, the owners of the Courier Express announced they were shutting down for good. They'd had enough. They finally realized they were in a war they just couldn't win, against an opponent with seemingly endless resources. So they folded. The 5-year war was finally won. So with the competition gone, the entire economic picture just changed overnight. The 5-year struggle gave way to the spectacular rewards of victory. That broken toll bridge was finally about to be rebuilt into a fortress.
Get this. Just a few months after the Courier Express folded, Forbes magazine took a look at the new monopoly in town, the Buffalo News, and estimated its value. The number they came up with? $400 million. I mean, what an absolutely incredible turnaround.
And that valuation wasn't just some number on paper. The newspaper immediately turned into a cash-generating machine. By the 1990s, it had already sent almost $300 million in profits back to Berkshire Hathaway. The original $35.5 million investment wasn't just recovered, it was returned nearly 10 times over. It became a true financial gusher for Berkshire.
But, the story doesn't quite end there. After the victory in '82 and those lush profits in the '90s, a new challenger came along that no one saw coming: the internet. And all of a sudden, the entire economic model of the newspaper industry started to crumble, posing a new kind of threat that even deep pockets couldn't easily defeat. The golden age was officially over. So, after all that, what can we take away from this incredible 5-year saga? Let's try to distill all that hard-won wisdom from this battle down into a few key principles.
Okay, first, see the potential. The true value of a business isn't always in today's numbers, but in its long-term strategic position. Second, trust the people. You have to empower good managers on the ground to navigate the local battles. Third, you've got to be able to endure the pain. A long-term horizon isn't just a nice-to-have, it's a requirement for surviving years of losses. And finally, number 4, have deep pockets. Financial reserves aren't just a safety net, they are an offensive weapon that lets you win a war of attrition.
And that really brings us to our final question. I mean, this was a war fought with newsprint and delivery trucks, right? But do these core principles, seeing that long-term potential, enduring incredible pain, and leveraging financial strength to outlast your competition, do those still hold true in today's world of constant digital disruption? It's a really interesting question to think about.
You know, when we think about Warren Buffett, we picture these huge, complex deals for massive companies. But what if I told you one of his absolute best investments, a real legend, wasn't done in some fancy boardroom? Nope, it was for 90% of a company based on a contract that was barely over a page long. No audit, no lawyers, just a handshake. So let's unpack how this ridiculously simple deal became one of the greatest business stories of all time.
This right here, this was the entire playbook. Sell cheap and tell the truth. That was the motto of Rose Blumpkin, or as everyone knew her, Mrs. B. And look, this wasn't some fluffy marketing slogan. It was the whole business plan that took Nebraska Furniture Mart, or NFM, from a tiny basement operation to an absolute retail giant.
And that's really the big question, isn't it? How on earth did this simple idea, from a 4'10" immigrant who never had a day of formal schooling, build an economic fortress so strong that Warren Buffett himself looked at it and said, you know what? It's way smarter to join them than to try and beat them. The answer? Well, it's all in the unbelievable story of Mrs. B.
All right, to really get why this business worked, you've got to understand the woman who built it. Her life story is just pure, unfiltered resilience, and it shaped literally every single thing about Nebraska Furniture Mart. I mean, just look at this journey for a second. At 23, she literally bribed guards with vodka to get across the Siberian border and escape the Russian Revolution. She lands in America, can't speak a word of English, with a tag around her neck that just says Fort Dodge, Iowa. For the next 5 years, she works nonstop, scraping together every single penny to bring her entire family over to the U.S. And then, at 43, she takes her life savings, $500, and starts a furniture store in a basement.
The odds against her were just insane. She was tiny, had zero education, and she was walking into a market completely controlled by these big, established stores. And these guys, they had all these cozy backroom deals to keep prices artificially high. They were not happy to see her show up and start shaking things up.
And this story, oh man, this tells you everything you need to know about her. So her competitors get manufacturers to boycott her, and then they sue her for violating these so-called fair trade laws, which were basically just price-fixing schemes. She goes to court and tells the judge, look, I pay $3 a yard for carpet, the big store sells it for almost $8. I sell it for under $4. What's wrong with that? I don't rob my customers. Well, the judge didn't just throw the case out. The very next day, he drove to her store and bought $1,400 worth of carpet from her. That story got in the paper, and her business just exploded.
Okay, so let's get into the nuts and bolts of how this sell cheap idea actually worked. It wasn't just about being the cheapest. It was this genius business model, a kind of self-feeding engine that just got stronger and stronger over time.
Check this out. This is where you see the magic. This is her profit and loss statement from 1946. Look at that line. Gross profit, 17.77%. For a furniture store, that is an unbelievably thin margin. She was basically giving all the savings to her customers, just keeping a tiny slice to keep the lights on and grow a little. That one number, that was the engine for the entire business.
And that tiny margin created this incredible feedback loop, this flywheel. Because she had the lowest prices, she got the most customers, insane sales volume. That volume meant she could go to suppliers and get the absolute best deals, the lowest costs. And with the lowest costs in the business, well, she could turn around and make her prices even lower. It was this cycle that just kept spinning, building a competitive moat that nobody else could even think about crossing.
And if you want to see proof, just look at these numbers from right after Buffett bought in. NFM's operating expenses, payroll, rent, ads, the whole shebang, was about 16.5% of sales. Now look at a huge national competitor, Levitt's Furniture. Theirs was over 35%, more than double. This insane efficiency meant NFM could make a profit at prices that would literally bankrupt everybody else.
And you know, a huge piece of that efficiency came from a totally random event. In 1975, a tornado just wiped out one of their 2 stores, so they were forced to cram everything into the one location that was left. And that's when they had this huge aha moment. They realized customers actually preferred having one gigantic destination store with a massive selection. They were willing to drive for it. That one disaster taught them to go all in on a single giant location, which dropped their overhead even more.
So, by the early 1980s, you have this unstoppable retail force. And guess who'd been watching it all from just down the road for more than a decade? Warren Buffett. He knew it was special. When he finally got his chance to buy it, the deal he made was just as unique as Mrs. B herself.
So on his birthday in 1983, Buffett paid just over $55 million for 90% of the company. Now, based on the profits from the year before, that really wasn't a bargain price. By his own standards, he wasn't getting some screaming deal on the numbers alone. So, why did he do it?
Because the deal had nothing to do with the numbers. I mean, look at these terms. The whole thing was based on a contract that was barely a page long that Buffett wrote himself. He never asked to see audited financials, he didn't count their inventory, he did zero due diligence. This entire deal was built on one thing and one thing only: his absolute trust in Mrs. B and her family.
See, Buffett wasn't just buying assets on a balance sheet. He was buying the people. He famously said that if you gave him the choice between any top CEO in the country or the top graduates from the best business schools, he'd pick Mrs. B every single time. He knew that what she had. You just can't teach that in a classroom.
But the story doesn't stop there, not even close. The handshake was just the beginning of a new chapter of growth, and it cemented a legacy that shows just how brilliant the investment was and just how unstoppable Mrs. B truly was.
Now you might think, okay, Berkshire Hathaway buys them, now they're going to open an NFM in every city, right? Wrong. They did the exact opposite. They understood that the magic was in the formula. So instead of watering it down, they were incredibly disciplined. In the 40 years since the deal, they've only opened 3 more giant stores. The goal was to make the moat deeper, not just build a bigger kingdom.
And Mrs. B? Oh, she kept working her usual 7 days a week. But in 1989, when she was 95 years old, she got into a fight with her grandsons, who were running the store by then. They wanted to remodel her beloved carpet department. She didn't like the plan, so she quit.
But did she retire? Oh no, she took her savings, bought the building right across the street from Nebraska Furniture Mart, and opened up a brand new competing business, Mrs. B's Clearance and Factory Outlet. At 95 years old, she went into direct competition with her own family and with Warren Buffett. And it got so successful that 3 years later, NFM had to buy her out. She kept working, by the way, until she was 103.
So, did Buffett's big bet on trust instead of spreadsheets actually pay off? Well, the numbers kind of speak for themselves, don't they? Berkshire's cut of the profits grew more than tenfold in less than 30 years. This wasn't just a good deal. It was a spectacular home run, and it was all built on a handshake.
So after all that, what can we really learn here? I mean, the NFM story isn't just a feel-good tale. It's a genuine masterclass in business and investing that is just as powerful today as it was back then.
Here's the blueprint that comes out of this story. First, follow great businesses, even if you can't own them yet. Buffett watched NFM for decades. He knew it inside and out long before he ever wrote a check. Second, a low-cost model isn't just a nice feature, it's a fortress. It lets you win a fight that nobody else can even survive. Third, you've got to look beyond 1 year of profits and see the long-term value of the business itself. Buffett bought the moat, not just the cash flow. Fourth, and this is the big one, partner with people you can trust completely, people with integrity and talent. Trust is a real bankable asset. And finally, when you have a winning formula, be super careful about changing it. The magic of NFM was its discipline.
And really, this quote from Buffett says it all, doesn't it? He bought a business so powerful, so dominant, that the very idea of trying to compete with it was just unthinkable. He saw that Mrs. B's simple philosophy, combined with her family's execution, had created a true economic fortress.
And that kind of leaves us with one final thought to chew on. Today, we live in a world of big data, complex algorithms, and due diligence that takes months and armies of analysts. But the story of this simple Omaha handshake really makes you ask a powerful question. What's the real, bottom-line value of just old-fashioned trust?
All right, let's dive into one of Warren Buffett's most legendary investments. Seriously, this story has it all. We're talking decades of patience, deep friendships, hostile corporate raiders, and of course, a multi-billion-dollar payoff. But the real magic here isn't just about the final number. It's about the masterclass in patient, people-first investing that got him there. So yeah, let's just start with the bottom line. Over the entire life of this investment, from the very first deal to the final sale, Berkshire Hathaway walked away with a profit of over 600%. It's a truly staggering figure that turned a $500 million check into almost $4 billion. But the real story, the one we're going to unpack, is how they did it. And you just gotta love this. Buffett himself, with his classic wit, basically calls himself out on the whole thing. Can you believe it? He'd actually bought and sold this exact same company years before for a loss. This one quote tells you everything you need to know. This is a story about patience, discipline, and waiting for the absolutely positively perfect moment to strike. Okay, so here's our game plan for breaking down this incredible story. First up, we'll talk about the 15-year friendship that laid all the groundwork. Then we get into the drama, the 400-pound gorilla deal itself. After that, we'll see how brilliant management created just massive value. We'll look at that jaw-dropping Disney payout. And finally, we'll pull out the key lessons you can take away from all of this. So, where does a multi-billion-dollar story like this even begin? Well, it wasn't with a fancy spreadsheet or a complex financial model. Nope. It all started with a simple friendship. It all came down to the deep, deep respect Warren Buffett had for one guy, Tom Murphy, the CEO of a media company called Capital Cities. I mean, just look at this timeline. It is staggering. Buffett knew this was a phenomenal company way back in the late 60s, but he waited. He even dipped his toe in the water in '77 and got a little burned, selling at a loss. It took a full 15 years for the perfect opportunity to show up. Think about that. That level of patience is almost unimaginable in today's world. And this chart right here shows you exactly why he had to be so patient. You see, Capital Cities wasn't some hidden secret. Everybody knew it was a winner, and the stock price just kept climbing and climbing, compounding at over 20% a year. The problem was simple. It was an amazing company, but for 15 long years, it was just too darn expensive to buy in a meaningful way. And this right here, this gets to the absolute heart of the story. For Buffett, it wasn't just about the business model or the assets. It was about the people running the show. He went on record saying Tom Murphy and Dan Burke were the best management team in the entire country. Their skill, their integrity, the kind of guys you'd want your daughter to marry. That deep trust was the non-negotiable foundation for the huge bet he was about to make. So after 15 years of patiently watching from the sidelines, the moment finally arrived. And it didn't just knock politely on the door. It kicked the door clean off its hinges in the form of one of the biggest, most audacious media mergers in history. Now, to really get this deal, you have to picture the mid-1980s, okay? This was the era of the movie Wall Street, junk bonds, hostile takeovers, the whole shebang. Corporate raiders were like sharks circling, and a huge established company like ABC was looking like a target. So when Tom Murphy from the much smaller Capital Cities decided he wanted to buy ABC, well, the odds were definitely not in his favor. And here's the brilliant play-by-play. So Murphy goes to ABC's founder, who actually likes the idea of a friendly merger, but he is terrified of raiders. He tells Murphy, look, I need a 400-pound gorilla, a huge, stable shareholder who can protect us. So who's the one person Murphy trusts to be that gorilla? He picks up the phone, calls his friend Warren Buffett, and Buffett gets it instantly, committing over $500 million right then and there to make the deal happen. And this next part is just an incredible detail. To show his complete and total faith, Buffett didn't just invest his money, he invested his trust. He literally handed Tom Murphy complete voting control over Berkshire's entire 18% stake for over a decade. He put Murphy in the driver's seat, securing the deal and proving to everyone that this was a real partnership, not just some financial transaction. Okay, so Buffett made this huge bet on Tom Murphy's management. Now we get to see exactly why. This is where Murphy's operational genius was just unleashed, and boy, did it pay off. This comparison right here tells you the whole story. Before the merger, look at this. ABC had almost 4 times the revenue of Capital Cities, But now look at the profits. They're practically the same. Capital Cities was an incredibly lean, mean, profit-making machine. And Buffett knew that if you applied Murphy's operating style to ABC's giant business, the result would be absolutely explosive. And Murphy did not waste a single second putting his playbook into action. Operations were decentralized to empower local managers. Extreme cost controls came in, so goodbye to the $60,000 florist bill and the fleet of limos. The new focus was simple: profits, not just ratings, and every single spare dollar was used to attack the mountain of debt they took on to do the merger. And the results? Well, they speak for themselves. Just look at this table. In just 2 years, from 86 to 88, the profits of the combined company more than doubled. By 1989, they were pushing $500 million. Now, this wasn't some kind of fancy financial engineering. This was just pure operational excellence, creating real, tangible value. And buried inside that huge ABC acquisition was this little hidden jewel, ESPN. At the time, it was losing $40 million a year, but Murphy and Buffett, they saw the potential. Under their management, it went from a total money pit to a cash gusher, eventually becoming one of the most valuable media properties on the entire planet. So the business is humming along, profits are soaring, and the investment is already a massive success. But the story is not over yet, not even close. The final massive payoff came from a completely unexpected place, a chance encounter on a street in Sun Valley, Idaho, of all places. It honestly sounds like something straight out of a movie. In 1995, Buffett literally bumps into Disney CEO Michael Eisner on the street after a conference. They start chatting, the idea of a merger somehow comes up, and within weeks, a $19 billion deal is struck. A completely casual conversation kicked off the final incredible chapter of this investment journey. And here it is, the final jaw-dropping tally. You see that initial $500 million investment? Well, they got all of that back, plus a profit, just by selling a third of their shares in '93. Then the Disney deal happened, adding another $2.5 billion in cash and stock. And selling that Disney stock later on, that brought in another $2 billion. It is just a monumental return built piece by piece over decades. Okay, so what are the big takeaways? After this whole 30-year saga, what are the core principles we can actually pull from this masterclass in investing? Well, the first lesson is all about the kind of business to look for. Buffett has a name for it, an economic franchise. The best way to think about it is to imagine you own the only bridge into a town. You provide a service people need, there are no other options, and you basically get to set the price. That's what a local TV station or a dominant newspaper used to be. They were like toll bridges for information, and that's the kind of business that just gushes cash. And really, it all boils down to these core principles. Number 1, invest in people you trust completely. 2, be incredibly patient. The right business is worth waiting decades for. 3, stick to your circle of competence, the businesses you truly understand inside and out. And 4, think like an owner. That means you should focus on your share of the company's total profit, what Buffett calls look-through earnings, not just the tiny little piece they might send you as a dividend. I love this quote because it just gets right to the heart of his philosophy. Buffett would so much rather pay a fair price for a wonderful business, a really sturdy vessel, than get a bargain on a mediocre business that's always taking on water. All his energy went into finding the right boat, which was Capital Cities, not trying to fix a leaky one. And that brings us to the final and maybe the most critical lesson of all. Buffett's focus was always on the playing field, the actual performance of the business, the profits, the management decisions. The scoreboard, that flickering stock price every day, that was just noise. So the question for all of us is, when we look at our own investments, are we actually watching the game, or are we just staring at the scoreboard? So today, we're going to break down one of Warren Buffett's most insightful deals ever, the acquisition of the conglomerate Scott Fetzer. This story has it all: corporate raiders, a CEO who stood his ground, and a simple one-page letter from Omaha. And this deal didn't just save a company, it gave us a masterclass in some of Buffett's most important investment principles. We're going to start with the high-stakes business drama of the 1980s, and then we're going to dive right into the heart of Buffett's thinking. We'll see how the deal actually went down, why it turned out to be so ridiculously successful, and, most importantly, what it teaches all of us about how to truly value a business. All right, let's set the scene. Picture this. It's 1984. The era of junk bonds and hostile takeovers is in full swing. And right in the middle of it all is a company called Scott Fetzer. Now, this was a really diverse company. They made everything from World Book encyclopedias to Kirby vacuum cleaners. And it was all led by their very dedicated CEO, a guy named Ralph Shea. I mean, the pressure on this company was just relentless. For over a year, Scott Fetzer was constantly in the crosshairs. First, you had the infamous corporate raider Ivan Boyski making a play. When they thought that off, management tried to buy the company themselves, but the whole thing just collapsed because they couldn't get the financing. And just when they probably thought they could breathe, boom, another bid comes in from the Rawless brothers, fueled by that risky, high-yield debt. The company's future was, really hanging by a thread. And this is the man right in the center of that storm, Ralph Shea. This quote, it just gets right to the heart of the conflict. See, for the Raiders, this was all just a financial game. But for Shea, it was about protecting the people who had built the company. He wasn't just some manager. He saw himself as a steward, and he was desperately trying to find a way out that didn't involve just gutting the business he'd worked so hard to build. And then, right when things looked their bleakest, an offer shows up that was the complete opposite of a Wall Street attack. There were no investment bankers, no crazy debt structures, just a single page in the mail from an investor out in Omaha, Nebraska, who'd been following the whole saga in the news. And this just lays it all out, doesn't it? It was a clash of two completely different universes. On one side, you have the Raiders' playbook. Load up on debt, break the company into pieces to make a quick buck, and just leave the wreckage behind for everyone else to deal with. And on the other side, you've got Warren Buffett's approach. An all-cash deal, a promise to let good managers do their thing, and a focus on, forever, not just the next fiscal quarter. For a CEO like Shea, this wasn't just a lifeline. It was the perfect home for his company that he never even knew existed. And this is basically the gist of that letter from Buffett. It's so direct, so free of any ego. I mean, it was almost unheard of in the corporate world back then. No pressure, no games, just a simple, straightforward proposition from one business owner to another. So Shea called him up, they met on a Sunday in Chicago, and by the end of the night, they had a deal, just like that. So what happened after Berkshire Hathaway actually took over? Okay, this is where the story goes from a tense corporate drama to a legendary investment case study. The results, frankly, were nothing short of astonishing. Let's start with the price. Berkshire's net cost, once you factor in the extra cash that was already sitting in Scott Fetzer's bank account, was just over $315 million. Now, I want you to keep that number in your head because what comes next is pretty incredible. So, freed from all the distractions of Wall Street and the corporate raiders, and basically just empowered by Buffett, Ralph Shea and his team just went to work. And the results were immediate and spectacular. Net earnings just took off, more than doubling over the next decade and a half. This wasn't some slow and steady business. It was a cash-generating powerhouse that was just waiting to be unleashed. But here's the truly mind-blowing part. Look at the relationship between the income and the dividends. In just the first 9 years, Scott Fetzer generated about $555 million in profit. But, and this is the key, because the business was so efficient and didn't need a ton of new capital, it was able to send $634 million in cash dividends back to Berkshire. It paid back its entire purchase price twice over in less than a decade. Just incredible. The wild success of this deal actually lets us peek behind a curtain and decode one of Buffett's most important tools for valuation. Because this acquisition gives us the only public example of him breaking down a concept he calls owner earnings. So what in the world are owner earnings? Well, to put it simply, it's Buffett's way of figuring out the real cash a business produces for its owners in a given year. It's not some accounting fiction, it's an estimate of economic reality. And for him, it's the bedrock of how he thinks about what a company is actually worth. And the formula is deceptively simple. First, you start with net income, the number everybody looks at. Second, you add back non-cash charges, like depreciation. But here, and this is the crucial third step that so many people miss, you have to subtract the actual cash the company needs to spend on average each year just to stay competitive, to maintain its factories, its equipment, and its spot in the marketplace. So Buffett actually laid this all out in the appendix to his 1986 shareholder letter. He started with the reported earnings, $40.2 million. He added back the $8.3 million in depreciation, but then he estimated that the business needed to spend about that same amount, $8.3 million, just to maintain itself. So in this very specific case, owner earnings ended up being the same as reported earnings. And this gets to a really crucial warning from Buffett. Don't get fooled by that popular cash flow metric. That number usually just adds back depreciation and totally ignores the very real cost of capital expenditures. This is also why you'll hear him be so critical of modern metrics like EBITDA. That's earnings before interest, taxes, depreciation, and amortization, because it also pretends that this real cash cost of staying in business just doesn't exist. Okay, so this whole idea of real cash leads us to another huge concept this deal just brings to light: the massive, massive difference between a company's accounting value, what we call book value, and its true economic value, its intrinsic value. Intrinsic value, that's the holy grail. It's an estimate of what a business is truly worth. You calculate it by forecasting all the owner earnings it can produce from now until, well, forever. And then you discount that cash back to today's dollars. The college education analogy is perfect. Its book value is what you paid in tuition, but its intrinsic value is the lifetime of higher earnings it gives you. They are two very different things. Now, this is just fascinating because Scott Fetzer was sending so much cash back home to Berkshire, its book value, its net worth on paper, actually shrank by almost half over these 8 years. But at the exact same time, its earning power, its after-tax income, nearly doubled. This proves Buffett's point perfectly. Book value tells you very little, and sometimes it tells you the exact wrong story about a company's true worth. Okay, let's bring this all home. This one deal is such a rich source of wisdom. Let's try and distill this incredible story down into a few powerful lessons about business, management, and just smart investing. All right, first, focus on owner earnings, not the accounting fluff. Second, you have to understand that a business's real worth is its future cash-generating power, not what the balance sheet says today. Third, you got to pay your managers in a way that makes them think like owners. Fourth, a good reputation is a massive competitive advantage. I mean, Straw came to Buffett because he was the honorable choice. And finally, you don't need to do crazy, extraordinary things to get extraordinary results. And on that point about motivating managers, this detail is just perfect. Buffett's deal with Shai wasn't some 100-page document cooked up by a team of consultants. It was a simple, one-page agreement they worked out in 5 minutes. It rewarded Shai for getting great returns on the capital he used, and it gave him every reason to send cash he couldn't use effectively back to Omaha. It was simple, aligned, and absolutely brilliant. But beyond all the numbers and the formulas, this is what it really comes down to. These words from Ralph Shelley, they capture the secret sauce of the Berkshire culture. It's not just about the money. It's about creating a partnership of trust and mutual respect that inspires people to do their absolute best work. And that really leaves us with this final thought. The Scott Fetzer story teaches us to look past all the superficial numbers, like reported earnings and book value. So the question to ask yourself is this: how many opportunities are we all missing in our investments, in our careers, maybe even in the people we meet, all because we're using the wrong scorecard?
So, how does one of the world's greatest investors find his next big win? Well, it's not through fancy Wall Street bankers or complicated pitch decks. Nope, it's through a simple ad. We're about to unpack the incredible story of how Warren Buffett found a perfect, fortress-like business and what it teaches all of us about the real source of value in any company. It's a true masterclass in investing, and it all started in a really, really unusual way.
So instead of relying on the usual suspects, Buffett put out a call directly to his own shareholders. As you can see from his own words here, he was looking for businesses with consistent earning power, and they had to be simple. Think about that. He basically turned his thousands of readers, many of whom were successful business owners themselves, into his own personal deal sourcing team. It's genius, really.
In this slide, this is his exact blueprint. There's no fluff, no wiggle room. It's just a clear set of rules. He wasn't chasing some speculative turnaround or the next hot tech thing. He wanted proven, profitable, simple businesses run by great people with a price tag right up front. This was his clear-cut, no-nonsense formula for success.
Okay, so we're going to follow this story through 5 key parts, from the unique ad that started the whole thing, to the incredible financial results, and then finally, the ultimate lesson Buffett took away from the entire experience.
All right, let's kick things off with Section 1 and see how this wild idea of advertising for acquisitions actually worked out.
So that ad caught the eye of a guy named Robert Heldman, a longtime Berkshire shareholder who just knew his family's company, Fedgemer Brothers, was a perfect fit. The only problem? Buffett had never even heard of it. So Hellman had to write to him multiple times, really laying out why his company was so great before he finally got a response. It was that persistence that opened the door to one of Berkshire's best investments ever.
So what was this company that so perfectly matched Buffett's wish list? Let's dig in and take a closer look.
Fedgemer Brothers was a classic, dead simple business to understand. I mean, it was founded way back in 1842. It had been operating for over a century, building this deep, trusted relationship with its customers. This wasn't some fast-changing, disruptive tech company. It was a rock-solid pillar of a stable, absolutely necessary industry.
You've probably heard Buffett talk about businesses having a moat, a durable competitive advantage that protects them from invaders. Well, Fedgemer was the perfect example of what he calls a fortress-like business franchise. It was a company that was incredibly difficult to attack.
So what made this fortress so strong? As you can see here, it came down to 4 key pillars. First, a lot of their uniforms were required by law to be made in the USA. That's a huge barrier. Second, they had the expertise to make custom stuff. Third, their Flying Cross brand was a powerful symbol of quality. People trusted it. And finally, being the market leader meant they had economies of scale that no competitor could even dream of matching.
So, with the perfect business identified, the next step was striking a deal. And, true to form for this story, they did it in a place you would never, ever expect.
Get this, Buffett and his partner Charlie Munger never even visited the company's plant in Cincinnati. Instead, they flew into this tiny remote settlement in Idaho to meet the Hellmans, a place so isolated it didn't even have a road. And right there, on a riverbank, they struck a deal for $46.2 million. It wasn't based on spreadsheets and PowerPoint. It was based on the quality of the business, and more importantly, the character of the people running it.
And this wasn't a one-off. This was classic Buffett. It's the same playbook he used when he bought the Nebraska Furniture Mart. He wasn't just buying a company, he was buying into a family. The Hellmans loved their business and wanted to keep running it, but they needed a permanent home for it, and Berkshire was the perfect partner for that.
But the story doesn't stop with the handshake deal. The real magic, the real genius of it all, became clear in the years that followed, as the financial results revealed the true power of this investment philosophy.
Buffett used this fantastic analogy to explain that most investors are always chasing the thrill of the new thing, the exotic businesses. But the best returns, they often come from the simple, steady companies, the girl next door, that just quietly master their craft, day in and day out.
And here's the proof in the pudding. Just look at this table. It shows the steady, consistent earnings Fedgemer delivered year after year. This isn't some explosive, headline-grabbing growth. It's something much, much better, a reliable cash machine. Now look at that cumulative column. You can just see how those profits started piling up, paying back that initial investment incredibly fast. Okay, this right here is the kicker. Are you ready? In just 7 years, the investment completely paid for itself. Berkshire got its entire $46.2 million back from its share of the profits. Just think about that for a second. Every single dollar of earnings after 1993 was pure profit on an asset that was now effectively free. It's just unbelievable.
And Fedgemer's success wasn't some fluke within Berkshire. It was actually part of this elite group of companies that Buffett affectionately called the Sainted Seven. These were his core businesses, and when you look at them all together, you see this absolutely incredible economic engine at work.
As a group, these businesses produced just astounding returns. In 1987 alone, they generated $180 million in pre-tax earnings. I mean, these are just amazing numbers. And that came out to a return on equity of 57%. That means for every dollar they had invested in themselves, they were generating 57 cents in profit. That is just insane. And as you can see, that incredible performance just kept on going. Now, you might be thinking, okay, 57%, is that good? Well, let me put it this way. That same year, a study looked at the 1,000 largest companies in the US. The single best performing company out of that entire group only managed a 40.2% return on equity. So Buffett's little group of boring businesses didn't just beat the best, they absolutely dwarfed it. They were in a completely different league. This is what an economic fortress looks like in numbers.
So, where did this incredible, almost unbelievable performance come from? Was there something magical about the uniform industry itself?
Well, according to Buffett, not at all. The secret was something much more fundamental.
Buffett was crystal clear on this point. He said it himself. The secret ingredient wasn't the product, it was the people. It was the Heldman family, who knew that business inside and out, absolutely loved what they did, and operated with an owner's mindset. That was the magic.
And this wasn't just some nice thing to say. This belief was the absolute cornerstone of his strategy, not just for the Sainted Seven, but for all of Berkshire. A great business is important, for sure. But a great business run by truly exceptional managers, well, that's the real key to sustainable, long-term success.
So, what's the big takeaway for us from all this? Two powerful ideas that are just as relevant today as they were back then. First, focus on the return on capital, not just growth for growth's sake. A business that earns fantastic returns is way better than a fast-growing one that just burns through cash. And second, and this is probably the most important part, never, ever underestimate the power of exceptional people. A great manager can take an ordinary business and make it truly extraordinary.
You know, this whole story took place back in 1986, but the principles of focusing on quality businesses and quality people are absolutely timeless, which leaves us with a final thought to chew on. In our modern world with everyone chasing disruption and the next big thing, what simple, durable, and wonderfully boring businesses are we all missing?
You know, when you think of Warren Buffett, you probably picture this unbroken chain of massive successes. But what about his single biggest failure? And here's the thing, it's not a story about losing a bunch of money. It's a story about a colossal misjudgment of character, of culture, that nearly cost him the one thing he values more than anything else, his reputation. And this quote right here, this is the key to the whole thing. Before we even get into the numbers, this sets the stage perfectly. For Buffett, you can always go out and make more money. But a reputation, once that's gone, it's pretty much gone forever. And the investment we're about to dive into put that exact principle to the ultimate test. So, our story kind of breaks down into 5 acts. We're going to start with a problem most of us would, love to have. Way too much cash. Then we'll look at the seemingly safe bet Buffett made on Wall Street. From there, we'll uncover the deep rot that almost brought the whole thing crashing down, see how Buffett himself had to jump in to save it, and finally unpack the incredible, timeless lesson at the heart of this entire saga. Okay, let's set the scene. It's the mid-1980s, and for Berkshire Hathaway, business is, well, it's booming. The company's insurance operations and all its other businesses are just pumping out a veritable gusher of cash. And look, the scale of this problem was just immense. I mean, look at these earnings. We're talking hundreds of millions of dollars flowing into Berkshire's bank accounts every single year. This created what you might call a high-class problem for Buffett, where on earth do you invest this much money when your entire philosophy is built on finding a good bargain? And what made this problem even harder was the market itself. The Dow Jones had been on an absolute tear, more than tripling in just about 5 years. Now, for a disciplined value investor like Buffett, who famously wants to buy great companies at fair prices, a soaring market like this is a total desert. Everything looks wildly expensive, and the risk of overpaying is just everywhere. And this quote, man, it just perfectly captures his mindset, right? He had all this cash just burning a hole in his pocket, but he flat out refused to chase an irrational market. He was practicing what he calls masterly inactivity, which is just the incredible discipline to do nothing when there are no good moves to make. He was frustrated, for sure, but he was patient. He was waiting for the right pitch. So, after all that waiting, what happens? An opportunity finally pops up. But it wasn't in some sleepy manufacturing company or a predictable soap brand. Nope. The pitch Buffett decided to swing at was an investment right in the heart of an industry he'd long criticized for its greedy, get-rich-quick culture, Wall Street. Okay, so this whole deal, it really came down to the relationship between these two guys. On one side, you have John Gutfreund, the tough, domineering CEO of Salomon Inc., literally known as the King of Wall Street. On the other, the Oracle of Omaha. Now, Buffett famously invests in people as much as he invests in businesses, and he had developed a deep trust in Gutfreund years earlier during the rescue of GEICO. He saw Gutfreund as an honest, competent leader in a sea of sharks, and that personal assessment, that bet on the man, was about to become the foundation for a massive, massive investment. Now, Buffett didn't just go out and buy regular stock. He insisted on a very specific, much safer kind of investment, convertible preferred stock. Think of it as a safety-first approach. It paid a high fixed dividend, just like a bond would, giving him a reliable income stream. But, and this is the cool part, it also came with an option, like a lottery ticket, to convert those shares into common stock if Solomon's business really took off. It was designed to give him a solid floor with a potentially sky-high ceiling. And the sheer size of this bet, wow, it was absolutely breathtaking, $700 million. I mean, to put that into perspective, this was the largest single investment Buffett had ever made. It represented a full quarter of Berkshire Hathaway's entire net worth at the time. It was a monumental vote of confidence, not just in Salomon the company, but really in John Gottfried the man.
And on paper, the deal just looked fortress solid. Berkshire would get a massive $63 million a year in dividends. They have that great option to convert to common stock at a reasonable price. And hey, if things didn't work out, Salomon was legally obligated to buy back the shares over 5 years. As a final layer of security, Buffett and his partner Charlie Munger would take seats on the board. I mean, what could possibly go wrong?
Well, as it turns out, pretty much everything, because all the fancy financial engineering in the deal couldn't protect Buffett from the one thing he totally misjudged, the corporate culture. And this is where the story takes a really dark turn. So once they're on the board, Buffett and Munger were just flabbergasted. They saw a culture where senior management was rewarding themselves with enormous bonuses even when the company's performance was terrible and shareholders were getting crushed. In 1 year, 106 people made over $1 million each, while the firm's profits were basically flat. And when they protested, they were pretty much told, hey, this is Wall Street. This is how it's done. Their concerns were just completely shrugged off. And then, that rot, it just exploded into a full-blown catastrophe. In April of 1991, a top trader admits to his boss that he'd been rigging U.S. Treasury bond auctions, a major federal crime. But what happened next was so much worse. Instead of immediately reporting it, Salomon's top executives, including John Goodfriend, just sat on the information for 4 agonizing months. When the cover-up was finally revealed in August, all hell broke loose. The market lost all faith in Salomon, and its creditors started pulling their money out as fast as they could. You have to understand, a firm like Salomon runs on confidence. It was borrowing over $150 billion, a lot of it overnight or every week, just to finance its operations. The second its lenders got nervous, they could simply say, nope, we're not lending you any more money. It's the modern version of a run on the bank. And for Salomon, it meant a corporate death spiral was just days, maybe even hours away. So the firm is just teetering on the edge of total collapse. The man Buffett had trusted, Gottfried, resigns in disgrace. And with his own $700 million investment and the entire 8,000-employee firm about to be wiped out, Buffett was forced to do the unthinkable. He agreed to step in as interim CEO. And his very first weekend on the job, it was an absolute nightmare. The U.S. Treasury, completely fed up with all the lies, delivered the final blow. It announced it was banning the firm from participating in Treasury auctions. Now, this wasn't just a slap on the wrist. This was a death sentence. It was a signal to the entire financial world that Salomon was toxic. The firm was going to die on Monday morning. Buffett just immediately leaped into action. He knew he had to regain the trust of the regulators, he had to find a credible new leader for the company, and he had to get in front of the press with a message of total, unflinching transparency. There was absolutely no time to waste. I mean, the whole thing, the fate of this massive firm, it all came down to one single, desperate phone call. Buffett got Treasury Secretary Nicholas Brady on the line, and with his voice literally cracking from the emotional strain, he didn't just plead for his investment, he pleaded for the stability of the entire financial system. He warned that if a firm the size of Salomon went under, it could set off a global chain reaction. He was leveraging the one asset he had left, his own personal reputation for integrity. And miraculously, Brady listened. The ban was partially lifted, and Salomon was given a fighting chance to survive.
Okay, so the firm is saved from instant death. But the hard part was just beginning. Now came the challenge of rebuilding a completely shattered culture and a tarnished name. And it was right in this moment that the true lesson of the whole Salomon saga finally emerged. Think about this. Just a few weeks later, Buffett had to go before Congress to explain exactly what had happened. This wasn't a friendly shareholder meeting. This was a public reckoning. And in his opening remarks, he didn't just apologize. He laid out an entirely new ethical code for the firm.
And this is what became famous as the newspaper test. It's so simple, but it's so profound. He told every single employee that after they'd obeyed all the rules,
They needed to apply this second test. Would they be comfortable with their family, their friends, and their neighbors reading about what they did on the front page of the morning paper? It was just a powerful way to recenter the entire organization, not on what was just legal, but on what was right. And get this, here's the wild financial punchline to this whole mess. After all the drama, the near-death experience, and the crisis management, Buffett ended up making a fortune. Take a look at the numbers. A total investment of about $1 billion turned into a profit of over $1.5 billion, for a really solid 14.5% annual return. So you see, the failure was never about the money. The failure was misjudging the culture and coming terrifyingly close to losing Berkshire's reputation right along with it. And that really brings us right back to the core lesson here. The Solomon Saga forced Buffett to put into words the principle he had always lived by, a simple, powerful test of character that, really, we can all apply. And it leaves us with two questions to think about. What is the ultimate price of your reputation? And are your actions today the ones you'd be proud to see on the front page tomorrow?
All right, let's dive into one of the most brilliant investment plays of all time, Warren Buffett's massive bet on Coca-Cola. So how on earth did a company that just sells fizzy, sugary water become one of the biggest wins in his entire career? Well, that's what we're here to find out.
So let's just start with the punchline, shall we? Buffett's initial investment of about $1.3 billion, it grew 20 times over. I mean, that is just an insane return, the kind of thing that cements you as a legend. But the number, as big as it is, isn't the real story. The real story is how and why it happened.
And this, right here, is the central mystery we need to solve. See, Buffett knew this brand was a powerhouse. He'd been drinking it since he was a kid, even sold it door to door. He got it. So why did he wait more than half a century to finally pull the trigger and invest? What was the magical thing that happened in 1988?
To crack this case, here's our game plan. First, we're going to get inside Buffett's head and understand his hunt for what he calls inevitable companies. Then, we'll take a deep dive into Coke's economic castle and see what makes it so darn strong. After that, we'll meet the two guys who really changed the game. Of course, we'll look at the jaw-dropping results and then wrap it all up with the key lessons we can all learn from this masterclass.
Okay, first things first. To understand this bet, you have to understand the way Warren Buffett sees the world. He's not just looking for good companies or stocks that might go up. No, he's on the hunt for something much, much rarer. He's looking for the inevitable.
Buffett has this fantastic thought experiment that just perfectly sums up his entire philosophy. Imagine you're blasting off to Mars for 10 years and you can't touch your portfolio the whole time. You get to make one investment before you go. What are you looking for? Hot tips? Fast growth? Nope. You are looking for one thing, and one thing only: certainty.
So what does he even mean by inevitable? Well, it's a business that's so dominant in an industry that's so simple and stable, you can be almost certain it will be on top for decades to come. Think about it. A hot new software company might be obsolete in 5 years. But are people going to stop wanting a cold, refreshing drink on a hot day? Not a chance. That's the kind of bedrock certainty he's after.
So Buffett's looking for an inevitable. Check. Now let's see exactly why Coca-Cola was the poster child for this idea. We're going to go inside what he calls its economic castle and figure out just how deep and wide its protective moat really is.
Okay, and this is maybe the most important part to get. The real secret formula of Coca-Cola isn't locked in a vault in Atlanta. It's locked inside our heads. For over 100 years, they've been building this incredible fortress, not with bricks and mortar, but with some pretty powerful psychological tricks. The first weapon in their arsenal is something called operant conditioning. Now, that sounds super academic and complicated, but the idea is incredibly simple. When you do something and get a nice little reward, your brain says, "Hey, I liked that, let's do it again." It's the basic science of habit formation. And Coke is the absolute master of this. Every time you have one, you get a bunch of little rewards, right? A little hydration, a familiar taste, that hit of sugar and caffeine. But here's the real genius move. They make sure that reward is always available. They talk about being within an arm's reach of desire. By being everywhere, they make it almost impossible for you to form a habit with a competitor. It's a brilliant, self-reinforcing loop. All right, pillar number 2 is a little more sneaky. This is Pavlovian or classical conditioning. You remember the story, right? Pavlov rings the bell, the dogs get food, and pretty soon, the dogs start drooling at just the sound of the bell. It's all about creating an automatic response through association.
Now, think about where Coke spends its billions in advertising. They are relentlessly linking that red and white logo to every single positive human experience you can imagine. Christmas, the Super Bowl, a day at the beach, laughing with friends. They are wallpapering your brain with these associations so that subconsciously, when you feel happy, you also feel a little thirsty for a Coke. It's brilliant.
And the final piece of this psychological puzzle is something called social proof. Look, at our core, we're herd animals. We're constantly looking around to see what everyone else is doing to figure out what we should be doing. If a lot of people are doing something, we just assume it must be the right thing to do.
Coke's superpower here is that it's just everywhere. You see it in movies, at the ball game, on giant billboards, in your friend's hand. This nonstop visibility sends a powerful signal to your brain, over and over and over. Coke is the normal choice. It's the standard. It's what people drink. Its own popularity becomes its best marketing tool.
Now, here is where it all comes together. And this is a key concept from Buffett's partner, the brilliant Charlie Munger. He calls this a Lollapalooza effect. These three forces, the habit loop, the happy associations, and the social proof, they don't just add together, they multiply each other. It's like 1 + 1 + 1 doesn't equal 3, it equals 30. They combine to create this unbreakable fortress of brand loyalty in your mind.
Okay, so we've established that Coke's business is an absolute fortress, right? It's the definition of an I inevitable. But that brings us back to our main question. If the castle was so strong, why the 52-year wait? What was the final trigger? Well, the answer wasn't in the syrup. It was in the corner office.
Enter Roberto Goetze and Don Cuve in 1981. They took over a company that had been kind of drifting. But these guys were different. They launched massive hits like Diet Coke. They even launched Cherry Coke, which was so good it famously got Buffett to switch from Pepsi after almost 50 years. But the really big change was how they thought about money. They got rid of all these weird side businesses the company owned, like a shrimp farm, I'm not kidding. And they focused like a laser on something called economic profit. Basically, they started acting like owners, making sure every single dollar they spent was actually creating more than $1 of real value for shareholders. It was a complete revolution.
And Buffett himself couldn't have said it better. This was it. This was the final piece of the puzzle. The magnificent but underutilized economic fortress finally had brilliant, disciplined generals in charge. They weren't just running the company, they were unleashing its true power. That was the change Buffett had been waiting for all those years. So, Buffett saw the fortress. He saw the new kings in the castle. He jumped in. So, what happened next? Let's get to the fun part and look at the payoff.
Let's forget about the stock price for just a second and look at the cold, hard cash that Coke was pumping out the Berkshire. In 1995, it was $88 million. Pretty good. By 2018, that annual check was up to $624 million. Now get this. By that point, Berkshire was getting back nearly half of its entire original investment in cash every single year. That's not just an investment, that's a money machine.
And, on top of all that cash rolling in, the stock itself did okay, too. That initial $1.3 billion, it turned into nearly $20 billion. This is just what happens when an unstoppable business meets world-class management. It's pure magic. The numbers are just jaw-dropping, right? But the real gold here, the thing we can actually use, is in the lessons we can pull from this incredible story.
So let's wrap up with the big takeaways. First, a truly great business can take a lot of punishment. Coke's moat was so wide it survived years of so-so management. Second, patience is everything. Buffett knew the business was great, but he waited for the right management and the right price. Third, and this is a big one, investing is often more about understanding people than it is about crunching numbers on a spreadsheet. And finally, never, ever underestimate the power of great managers. They can be the rocket fuel that turns a great company into a life-changing investment.
And that leaves us with one last question to chew on. Coca-Cola was sitting there for decades, hiding in plain sight. It took 52 years, but Buffett finally saw the full picture and made his move. So it makes you wonder, what powerful, dominant, inevitable is hiding in plain sight for us right now?
When you think about Warren Buffett's portfolio, you probably think of giants, right? Coca-Cola, American Express, Apple. But one of his most telling acquisitions, the one that might just reveal the most about his core philosophy, isn't some global behemoth. Nope, it's a single jewelry store in Omaha, Nebraska. So today, let's dive into the story of Borsheim's. and see how a 10-minute deal for a local shop became a true crown jewel for Berkshire Hathaway.
We have to start right here with this question, because this is a question Warren Buffett asked himself, with a whole lot of regret years after buying another legendary family business. He'd missed something that was right under his nose, a mistake he was not going to make a second time. And that one question, really, it sets the whole stage for a story about family, about hidden value, and about the incredible power of knowing exactly who you're getting into business with.
So here's how we're going to break this incredible story down. First, we're going to set the stage and get inside Buffett's head back in 1989. Then, we'll meet the Omaha institution that caught his eye. After that, we'll relive the famously fast deal, see what happened after Berkshire took over, and finally, we'll pull out the key lessons from this absolutely brilliant acquisition. All right, so to really get why Buffett would buy a jewelry store, we have to hop in the time machine and go back to the late 1980s. You see, it was a time when Berkshire Hathaway was just swimming in cash, but it was also a time of a really fierce debate about how the stock market even works.
So first, let's set the scene. Berkshire was an absolute cash-generating machine. In just the 24 months leading up to this deal, the company's businesses spun off over $800 million in new capital. Think about that. That's an average of $37 million a month that Buffett and his partner Charlie Munger had to find a home for. They were flush with cash, and they were on the hunt for the right kind of opportunity.
Now, what's so interesting about this period is this huge intellectual battle that was going on. In all the universities, the efficient markets hypothesis, or EMH, was the hot new thing. It basically said the market is always smart, always rational, everything is always perfectly priced, so you can't consistently beat it. But Buffett, he came from a totally different school of thought, one he liked to call Graham and Doddsville. He said, yeah, the market is frequently efficient, but not always. The mood swings of what he called Mr. Market create these amazing opportunities for patient, rational investors to find undervalued gems. He even joked that the professors teaching EMH were doing a huge favor for guys like him.
And Buffett was also on a mission to teach people about the dangers of churn. Constantly buying and selling stocks. And this slide just lays out his argument perfectly. Look at these two strategies. The churn strategy on the left, where you sell and pay taxes every single year, turns $1 into about 25 grand. Not bad, right? But now look at the hold strategy on the right. By letting that exact same investment grow and only paying taxes one time at the very end, that single dollar turns into almost $700,000. It's a staggering difference, and it all comes down to one thing: the incredible power of putting off paying your taxes.
But for Buffett, it wasn't even really about the math. That was just a nice bonus. He and Munger had figured out that finding great people to partner with was incredibly rare. And when they did, those relationships were just enjoyable. So the idea of giving those up just to chase a slightly better return by constantly churning through companies, for him, as you can see in this quote, that was like marrying for money, especially when you're already rich. It was just insane. Okay, so with that philosophy, that mindset firmly in place, looking for great businesses run by great people to hold on to forever, a target came into view, and it was right in Buffett's own backyard. This wasn't just some store. It was a local legend built on a really powerful, very specific philosophy.
Now, Borsheims had been around in Omaha forever, since 1870, but the modern story really kicks off with Rebecca Friedman. Now, get this. She was the sister of the legendary Mrs. B, the founder of Nebraska Furniture Mart, which Buffett had already bought back in '83. Mrs. B had worked like crazy to bring her family to America, and in 1922, Rebecca finally made it. After decades of hard work, she and her husband Louis scraped together enough money to buy the little Borsheims shop in 1947, and that's where this retail dynasty really began.
And their business model? Well, it was practically a carbon copy of Nebraska Furniture Mart's. It was a simple but just devastatingly effective philosophy, all laid out right here. They had one single, massive location. They had a selection that was just enormous. Their whole motto was sell cheap and tell the truth. And this created this powerful, what you call the virtuous circle. Their huge sales volume let them demand rock-bottom prices from suppliers, and then they passed those savings right on to their customers, which just drove their sales volume even higher. It was a total family affair, and they were obsessed with every single little detail.
And this is where that quote from the beginning comes crashing back in. After he bought Nebraska Furniture Mart, Buffett just kicked himself. He said he totally blundered by not asking Mrs. B the most obvious question in the world. Are there any more at home like you? He realized way too late
that the exact same family genius, the same incredible business model that built NFM, was humming along just down the road at Borsheim's, run by her sister's family.
So once Buffett realized his mistake, he did not mess around. And what happened next became the stuff of legend, not because it was complicated, but because it was just so shockingly simple. This was a deal built entirely on trust, not on spreadsheets.
So get this, the whole thing kicks off with a joke. It's late 1988, and Buffett, who'd been a customer for years, is in the store shopping for a ring. Ike Friedman's son-in-law, Donald Yale, sees him and just yells out, "Don't sell Warren the ring, sell him the store." Well, that joke planted a seed. After the holidays, Buffett picked up the phone, called Ike Friedman, and just asked if he'd ever consider selling.
So they set up a meeting at Ike Friedman's house. What happened next wasn't some long, drawn-out negotiation. I'm not kidding, it was a 10-minute conversation. Buffett asked exactly 5 questions, the ones you see right here. Ike answered the first 4 about sales, profits, expenses, and inventory completely from memory. But it was that 5th question that was the most important. Would the family stay on to run things? Ike said yes, and just like that, the deal was done.
I mean, let's just stop and think about how wild this was. A deal for 80% of a huge business, done in 10 minutes. Buffett never asked to see audited financials. He didn't send in teams of accountants to count the diamonds or check the books. The contract was a single page. The legal fees were a tiny $1,100. This was not a deal based on exhaustive due diligence. It was based entirely on reputation and character.
And Buffett himself explained it better than anyone could. He said most people, when they're buying jewelry, they feel like babes in the woods. You can't really judge the quality or the price. So the only rule that makes any sense is this: if you don't know jewelry, know the jeweler. Buffett knew Ike Friedman. He knew his reputation for rock-solid integrity. So when Ike told him the numbers, Buffett just believed him. And on that basis, they wrote a very large check. It was truly that simple.
So what happens after a deal like that? Did Berkshire's corporate machine swoop in and change everything? Not even close. What happened next was a perfect example of Buffett's partnership model in action, and it turned Borsheim's from an Omaha institution into a global pilgrimage site for investors.
Right after the deal closed, Buffett gave Ike Friedman and his family his one and only instruction. His exact words were, "Forget that it happened and just keep doing what you were doing." That was it. No meetings about synergy, no 5-year growth plans, no management shakeups. Just complete and total trust that the people who had built this amazing business knew how to run it.
But Buffett did bring one thing to the table, his incredible marketing genius. Borsheim's became the absolute centerpiece of the Berkshire Hathaway annual shareholders meeting weekend. They started holding these cocktail receptions that now host over 40,000 people. Buffett himself gets on the sales floor offering crazy Warren prices. Charlie Munger would literally sign sales receipts for customers. You'd see Bill Gates playing table tennis against a champion, or Buffett playing bridge against the best in the world. It became this legendary must-do event, part of the magic of being a Berkshire shareholder.
And the results, they were just phenomenal. The store's physical footprint has exploded, grown over 200% from 20,000 square feet to more than 62,000 today. The store gained so much prestige that when Bill Gates, the richest man in the world at the time, was ready to propose to Melinda French, it was Warren Buffett who personally took them to Borsheim's to pick out the ring. The Berkshire effect was real, it was tangible, and it was unbelievably powerful.
The true strength of that family culture was really put to the test when Ike Friedman tragically passed away just 2 years after the deal. But the business didn't miss a beat. Eventually, the leadership passed to a woman named Susan Jacques. She had started at Borsheim's as a shop assistant, making just $4 an hour. When Buffett made her CEO, he said this: "Her brains, her passion for the business, and her integrity, that's what mattered. That beats a fancy MBA any day of the week." It's the perfect example of his focus on character over credentials. Okay, so when you pull back and look at this whole story, from the philosophy to the deal to the incredible growth, what are the real lessons here? What can this one little jewelry store teach us about the entire Berkshire Hathaway playbook?
Well, it really boils down to 5 huge lessons. First, the benefits of combination. Berkshire gave them the cash and the publicity to supercharge what was already a great business. 2, a deep culture is priceless. That Friedman philosophy was so strong that the business thrived even after losing its key leaders. 3, don't get greedy. By keeping that virtuous circle going and passing savings to customers, they kept their dominant position. 4, market inefficiency is very real. This whole deal proves you can find incredible value if you just focus on the business and the people, not just the stock price. And finally, number 5, don't churn. Holding on for the long term created massive financial value, sure, but way more importantly, it preserved a wonderful, enjoyable business partnership.
And that brings us to a final, kind of powerful thought. The Borsheim's deal was done with 5 questions and a handshake. It was based on a reputation for integrity built over decades. In our world today, a world that is so obsessed with big data, with complex models, with algorithms, maybe the biggest, most overlooked inefficiency in the entire market isn't hidden in the numbers. Maybe it's in simply failing to properly value trust.
All right, let's dive into one of the all-time great investment stories. Seriously, it's a journey that takes us through 3 decades, involves 3 companies you definitely have in your house right now, and it's basically a masterclass in long-term strategy from, you guessed it, Warren Buffett.
So the whole thing really boils down to this one crazy question. How on earth did an investment in a shaving company eventually lead to owning the entire Duracell battery company? The answer is, well, it's a wild ride of crisis, opportunity, and some absolutely brilliant financial moves.
Okay, so let's set the scene. The year is 1986. Gillette is this iconic American company, a real giant in consumer goods. But behind the scenes, it's in a world of trouble. It's facing this relentless assault from the corporate raiders of Wall Street. Now, what's so interesting here is just how constant these attacks were. I mean, from 86 to 88, it was just nonstop. First, you got Ronald Perelman and Revlon, then Coniston Partners jumps in, and Gillette's management, they're fighting back tooth and nail, but their main weapon, borrowing a ton of money to buy back their own stock, it left them really wounded and financially exposed.
And that's where Warren Buffett saw his opening. You know, while the rest of Wall Street saw a company that could carve up and sell for parts, Buffett saw something totally different. He saw a fantastic business that had just, completely drained its bank account defending itself. He knew their desperation was his opportunity. So, and this is the crucial part, Gillette was in a really, really tough spot. They were swimming in debt. And if you looked at their balance sheet, they technically had a negative net worth. Their liabilities were actually greater than their assets. So they didn't need another attacker. They needed what's called a white squire, basically a friendly investor to ride in and save the day.
And that's exactly what Buffett was. But this wasn't some cold, calculated Wall Street deal. I love this part of the story. The whole thing was basically sealed over a simple lunch of hamburgers and Cokes. It was built on real, genuine respect between Buffett and Gillette's CEO at the time, Coleman Mockler.
So why was Buffett even interested, right, with that messy balance sheet? Well, it's because he saw what he calls an economic franchise. He saw that Gillette had this incredibly powerful brand, a deep connection with its customers, what he calls share of mind. And that created this protective moat around the business that allowed it to just pump out incredible profits year in and year out.
And this quote just nails that concept perfectly. For Buffett, it wasn't about some complicated spreadsheet. It was about this simple, powerful, undeniable reality. This daily, predictable need for their product, that was the real value of Gillette.
So let's actually look at the deal itself, because it's pretty clever. Buffett put in $600 million, but he did it in what's called preferred stock. Think of it as a safer bet. It gave his company, Berkshire Hathaway, a guaranteed 8.75% dividend every single year. In return, Gillette got the cash it was desperate for, paid down its debt, and got a powerful, stable shareholder who basically told all the raiders to get lost. It was a total win-win.
So now, with their finances totally secure, Gillette could finally get back to doing what it did best, innovating. And what happens next is what turns this from just a great deal into an absolutely legendary one.
Get this, just a few months after Buffett's investment, Gillette launched the Sensor Razor. They had spent over a decade and a fortune developing this thing, and it was a complete game changer. The public went absolutely nuts for it. Demand was so high, Gillette actually had to pull its ads off the air just so the factories, running 24/7, could even try to keep up.
And all that success, well, it sent profits through the roof, and Berkshire was right there to benefit. This table here is just a little snapshot of the payoff. You can see the cash dividends just growing and growing. But look at that second column. That's Berkshire's share of the profits that Gillette didn't pay out but kept to reinvest. Buffett's piece of that pie was getting bigger and bigger too. By 1991, his $600 million investment was already worth more than double.
So a normal person might have just cashed out with a quick billion-dollar profit, right? But Buffett wasn't playing a short game. He saw Gillette as an economic castle with a moat that was almost impossible to cross. He believed in its future earnings, and maybe most importantly, he really trusted the guys running the show. He was in this for the long haul.
And that brings us to the final and, frankly, the most brilliant act of this whole saga. The story keeps evolving, and through a series of mergers, this investment turns into this long strategic chess game that ends with one of Buffett's signature, masterful moves.
So fast forward to 2005. Another consumer giant, Procter & Gamble, comes along and buys Gillette in this massive $57 billion deal. Buffett actually called it a dream deal. And just like that, his Gillette shares, which started as that $600 million lifeline, automatically turned into a massive stake in the new, combined P&G powerhouse.
But then, here's the twist. About a decade later, P&G decides it wants to slim down a bit, and Buffett decides he wants to make a change too. He makes this decision to trade his entire multi-billion-dollar stake in this massive diversified company for just one of its smaller pieces, Duracell batteries. I mean, on the surface, that sounds like a kind of a weird trade, doesn't it?
But how he did it was pure genius. Let me walk you through this. First, Berkshire hands its $4.2 billion of P&G stock back to P&G. But in return, P&G doesn't just give them Duracell. No. First, they pump up Duracell with a $1.8 billion cash dowry. Then, Berkshire gets 100% ownership of this newly cash-rich Duracell. And the key to the whole thing, it was a direct swap, not a sale.
And this is why that was so brilliant. Because it was a swap, he avoided paying a fortune, literally billions, in capital gains taxes. He also felt like he was getting Duracell at a bargain price. On top of that, Buffett has always said he'd rather own 100% of a good business than a tiny piece of a giant one. And the cherry on top, that $1.8 billion cash dowry, was basically cash he pulled out of the investment, tax-free, that he could go use somewhere else. Just a masterstroke.
So, after this 3-decade epic, what can we really learn from it all? Because it's so much more than just a great investment. It's like a textbook of his most important principles. And this, right here, might be the biggest lesson of them all. The difference between a great business and a great investment. Look, P&G was and is an excellent business, no question. But in 2015, its stock price was pretty high. Duracell, on the other hand, was offered to him at a much more attractive price compared to what it was earning. For Buffett, it's simple. Price is what you pay, value is what you get. And Duracell was just the better value.
But there's more. I mean, the whole story just screams about how important it is to trust the people you're in business with. It shows how being that patient, friendly white squire can get you a deal that nobody else can. And, it's also a reminder that even the absolute best companies can get a little lazy and need a kick in the pants to get back on track.
So, when you boil it all down, what was the final score? Over those 3 decades, Berkshire's initial $600 million investment turned into an asset worth over 5.4 times billion dollars. That is a 9-fold return, and that's not even counting the hundreds of millions in cash dividends they collected along the way. Just incredible.
And this final quote just perfectly sums up the whole philosophy. It's not about chasing the next hot thing or crazy growth. It's about finding these super stable, dominant businesses that just gush cash, and then you just take that cash and you go buy more wonderful businesses. It's a simple but unbelievably powerful wealth-creating machine.
Which really just leaves us with one final thought to chew on. This whole story played out over 30 years. In our world, which is so obsessed with what's happening this second, this quarter, it really makes you stop and ask, what is the real power and the incredible value of just being willing to take the long view?